Depending on who you ask, Australia's housing market is either about to boom again or it's about to crash. And honestly, I get why. Because you've got headlines screaming inflation, they're sounding the alarm for the RBA hiking rates, and unemployment has dipped again. The cost of living still feels incredibly brutal, but then you look at house prices and they just refuse to slow down. And I've got the latest numbers right here from Cotality, from PropTrack, and from other outlets. We're going to look at the national picture first, and then we'll zoom into the city and regional numbers. And I'll also touch on rents because that's a massive part of what's pushing buyers into the market right now. And I'll be really honest here, I have not seen this happen before where the market is split down the middle like this, where two segments are behaving like they belong to two different countries. So I'm going to give you the full picture with the numbers. So the next time you hear someone say house prices are going to do this, you've actually got all the facts and all of the data. Right at the end, I'm going to lay out the two forces that are in a wrestling match right now. And I'll tell you which one I think wins in 2026 because prices are stuck in the middle and something has to give. Quick one before we jump in. I do these updates on property and the economy every single day. So if you want to stay ahead of the market and cut through the noise in a few minutes, hit subscribe and hit the bell, and then let's get into it. All right, let's start national. Cotality, which used to be CoreLogic, is Australia's biggest property data company. They track home values, listings, sales, rents, the whole lot. And this January update landed with a headline that surprised a lot of people. National home values rose 0.8% in January, almost 1% growth in just 30 days. In December, the national market rose 0.7%, so the pace actually picked up. Then you look at the split, and it gets even more interesting. Combined regional markets rose 1%. Don't get confused, regional includes a lot of big cities, Gold Coast, Newcastle, Geelong, and so on. You've got affordability stretched, you've got geopolitical noise everywhere, and the market still lifted close to 1% in a single month. If you're watching this and thinking, how is that even possible? You're not crazy. It feels messy because it is messy. Australia is not one housing market. It's a bunch of smaller markets moving at different speeds for different reasons all across the country. So that 0.8% national number is really just an average of very different stories happening at the same time. And the split I warned you about in the intro is real, but that's not the whole of it because there is a deeper split underneath these numbers that most people are missing. And we're going to get to it later because it's the clue to how 2026 plays out. Now let's zoom in because this is where the story gets very clear. Sydney barely moved. Sydney rose about 0.2% in January. That is a slow crawl. The reason is simple. Sydney is hitting an affordability wall. A lot of homes within 20 to 30 kilometers of the CBD are completely out of reach of most buyers. And when loans are that big, even rate talk alone can make buyers hesitate, can make them very nervous. Now, Melbourne is different. Melbourne rose about 0.1 to 0.2% depending on the index you look at. And here's the key point. Melbourne is not coming off a big boom like Sydney. Melbourne has been the laggard. So when Melbourne starts lifting, it's often catching up, not overheating. Now let's talk about the cities that are still running hot. Perth rose about 2% in January, and over the year, Perth house values are up about 18%. Perth also pushed into the $1 million club, which tells you demand is still overpowering the brakes. Brisbane rose about 1.6% in January, and over the year, Brisbane house values are up around 15%. Adelaide rose about 1.2 to 1.3% in January, and it's still one of the strongest performers on the year. Darwin rose about 1.5%. Canberra and Hobart were more middle of the road. Now here's the deeper split I teased earlier, and this is where the whole 2026 story sits. According to Cotality, the lowest price quartile, the bottom 25%, rose 1.3% in just 1 month. That's the part of the market where you're looking at more affordable stock, often under $1 million in many areas. And yes, if you run that pace out over a year, it's basically double-digit growth. Now let's look at the top 25%. This is the premium stock. It only rose 0.3%. That is a 1% gap in a single month. That is not a small difference, and this is the main thing I'm screaming right now. The 2026 property market is going to be driven by one factor and one factor only, and that is affordability. Now let's talk about the wrestling match, because there are real forces trying to slow this down. First is interest rates. Right now, everyone is staring at the RBA and the market reaction to the 0.25% hike. The fact it's been hiked hits confidence, because buyers do not buy with math only, they buy with emotion, and rate talk creates hesitation. Even before a hike happens, people start planning around it. They hold off, they second guess, they wait for clarity. That alone can cool momentum. Second is affordability. This is the most stretched affordability most Aussies have felt in real time. Rents have surged over the last few years. Groceries are up, bills are up, insurance is up, and people are trying to save deposits while getting squeezed from every single side. There is a ceiling. At some point, households just tap out, not because they want to, because they have to. So if you only looked at those two negatives, you'd expect prices to slow a lot harder. But then you look at January and the market still rose 0.8%. So let's talk about what's pushing back. As strong as the negatives are, the positives are still stronger right now, and there are three of them. First is housing supply, or in other words, the lack of it. The number of homes advertised for sale is about 19% lower than this time last year and about 25% below the 5-year average for this time of year. That is tight supply. And when supply is tight, buyers compete harder for whatever is available. Sales are also not collapsing. The rolling quarterly number of home sales is about 3% higher than a year ago and only around 2% below the 5-year average. So demand is still there. Second is urgency, and in plain English, FOMO. This is not silly hype, this is real psychology. People see prices rising month after month and they do the math in their heads. They think if I wait 6 months, I might pay another 50 grand for the same place. If I wait a year, I might be priced out. So buyers start to rush in, especially first home buyers, because the government schemes make it feel like the door is open right now, but it might not stay open forever. Then the bank of mum and dad piles in. Parents watch prices lifting fast and they think my kid will never catch up at this pace. So they gift, they guarantee, they loan, they pull equity, they do whatever they can to help their kids buy sooner. And investors are part of this too. Investors look at tight supply, low vacancy, strong rents, and they see a market where demand does not disappear. It just shifts to what people can afford. Third is population pressure. More people need more homes, simple as that. More renters will feel the squeeze. That keeps demand deeper than most people realize, even when affordability is ugly. So let's wrap all of that up. Affordability is not killing demand. Affordability is moving demand. That's why you get a two-speed market. The affordable end has a deeper buyer pool. You've got first-home buyers, upgraders, investors chasing yield, the bank of mum and dad. They all collide at the same price bracket, the same price point. That is why the bottom 25% is running hotter than the top 25%. The premium end is much more fragile. Once you're talking homes above 1.5 million to 2 million, buyers need bigger loans, and bigger loans get painful fast when rates start to rise, or even when rate fear rises. So the expensive end slows down first. That is why I hate when people lump Sydney and Melbourne together and call them both moderate. Sydney is slowing because it already boomed hard and it's hitting affordability ceilings. Melbourne is often catching up because it did not have the same run. Two different stories, and 2026 will treat them very differently. Forced selling will not explode on 1, 2, or even 3 rate hikes. So what do I think wins in 2026? Right now, the positive forces are winning. Tight supply, urgency, population pressure, and the demand stack at the affordable end. That is why prices are still rising even with rate fear in the background. The negative forces are real and they will slow parts of the market. They will hit the premium end first. They will hit the most expensive cities and the most expensive pockets first. That is already happening in the data. But unless we get a proper hiking cycle, I'm talking 4, 5, 6 rate increases, plus a big rise in unemployment, plus supply suddenly hits the market, this looks more like a market that shifts and splits, not a market that collapses in one clean move. And if you want to sanity check that view, remember this. Cotality also found 87% of industry leaders expect dwelling values to rise over the year ahead, and only 3.5% expect prices to fall. Queensland, WA, and SA were called out as the most bullish markets, areas of Melbourne, and some areas of New South Wales. So that's your update. I know the headlines are loud, and I know you guys are busy and do not have time to read every report and stitch the story together. That's why I do these videos. I take the data, I pull out the real trend, and I simplify it so you can actually use it. Let me know in the comments, do you think 2026 is a boom year, or do you think something finally breaks? And as always, if you want daily updates on the property market and the Aussie economy, subscribe and hit the bell, and I'll see you at the next video.